Okay, so good morning, everyone. It's great to see so many of you joining us for the analysis on last week's budget. There were a few surprises and some welcome news for the creative industries. I'm Francesca Robe, one of the media directors here at Kingston Smith in our West End team. I'm sure most of you are familiar with who we are. I can see from the attendees that we've got some familiar names and clients on the list. However, for those of you that don't know us so well, just a little bit of a background. So Kingston Smith are a top 10 audit, tax and advisory firm. We're actually the only accountants in the UK with a specialist media office here in the West End. So we've got over 100 people working exclusively with creative businesses, mainly in marketing services, TV and film, and the theatre sectors. We're also part of More Global, so an international network, and we've got a presence in over 100 countries. So that means we can support our international clients and also help with any expansion plans that you might have. So last week we had what we expect to be the last budget before the election. Normally, these budgets include something for everyone to try and increase popularity ahead of everybody going to vote. However, in the kind of lead up to budget day, our expectations were kind of managed, as we were told that actually there was going to be kind of very little fiscal headroom for bold moves. So to take us through the detail today, I'm delighted to be joined by two of my colleagues. Got Leigh Collins, who is a tax media partner, and Claire Robinson, who is a tax media director. Now, to start with, Claire's going to take us through the corporate tax announcements. If you have any questions as we're going through, please do use the Q&A function at the bottom of your screen. This means that I can try and kind of weave in questions as we go through, or if not, we can come back to you directly. So over to you, Claire, for us to start.
Thanks, Francesca, and yes, thank you everyone for joining. As Francesca said, I'm going to run through the changes on the corporate side. So, I mean, really, I'd say it really was kind of a budget for the creative sectors, other than the kind of welcome changes on that side. It was pretty uneventful. So I'm going to kick off with kind of what happened in the creative sectors, and then I will move on to briefly touch on a couple of other points. But yeah, the focus really is on what they've done to increase the reliefs there. So, I mean, there were quite a few creative sector changes across, well, kind of across all the different kind of specialisms in there. So with all the screen reliefs as well as the cultural reliefs. On the screen side, so that is the TV and film, we had the announcement of an increase to the audio-visual expenditure credit, particularly just for VFX costs. So, and then they've also announced, which was quite a surprise, the new independent film tax credit, which is going to give a higher rate of relief if you can qualify for that. Kind of aside from the tax, there was also an announcement that they are going to give rate relief for film studios to help cover rising costs there. And then on the cultural side, we have had notification that they are going to permanently increase the rates across the board, so for theatre, orchestra and museum and galleries. And they're also removing the sunset clause from museum and galleries. So that relief is now no longer going to cease. It will continue indefinitely in line with the other reliefs. I mean, this all came kind of off the back of quite a lot of changes that had already happened. So in the budget last year, it was announced that the mechanism for claiming relief over for film, TV and video games was going to change. So just briefly to touch on that, because it is relevant. And they work in a slightly different way to how people were claiming under the old film, high-end TV, etc. And basically what happens is that the credit is now going to come in above the line. So that means before a company is taxed. So basically the credit comes in and then you are subject to corporation tax on that. I mean, in terms of the rates, there was the headline rates. Next slide, please. The headline rates for the new expenditure credits are quite a bit higher. So there's 34% for general film and TV and video games, and that is increased to 39% for if you're doing animation or children's TV. Because they're coming in above the line, actually the effective rate is slightly higher than we had previously. So that was 25% for film and TV, and well, 25% across the board. So there is a slight increase there. Just thought it might be useful, as they are quite new still, just to kind of run through an example. I mean, this hasn't changed based on the budget, but just so we can talk through how it works, and just so I can show you the kind of the mechanism for the above the line. So here we've got a film production company making film with total expenditure of 100 million. That's all UK. And they have income of 50 million. So as you can see here, we have the income and expenditure to get to what would be the profit and loss, but then you add in the audiovisual expenditure credit above that profit and loss. So that basically comes in to the calculation, and then you then have to apply a notional corporation tax on that credit amount, and then you get to a repayable credit. And that repayable credit, the effective rate of that is 25.5%, as I just said. So then moving on to what has changed in line with that. So particularly for visual effects expenditure, there is going to be an increase to the credit rate. So that is going to come in line with the 39% that actually applies to children and animation expenditure. It's not going to be capped. So that basically means that you're going to get the effective rate of 29.5% on 100% of the visual effects spend. So that means that you will end up with a fair increase. You can see the example at the bottom there. You will end up with a fair increase on actually the relief you can obtain on that, which I think is a really welcome change by the government, and it has been targeted specifically at that, because I mean there was quite an awareness that VFX spend was moving outside of the UK, being very easy to move. So the hope is that will actually encourage people to keep that expenditure within the UK as well, rather than just filming. And then if we move on to the new independent film tax credit, so that I mean it's a really generous increase. So this is going to apply only to films where there is a projected core expenditure of 15 million or less. So when we're talking about core expenditure, that's your pre-production, shoot and post-production spend. There is going to be a new BFI test, so British Film Institute test, to establish whether companies can qualify for this. We have had some detail on that in the past week, and it's basically you're going to have to be required to have either a UK writer or UK director in order to qualify, as well as the kind of spend requirement. And if you do qualify under this, then your headline credit rate is going to increase to 53%. So that again, that's the amount that's coming in above the line, which is going to give an effective rate of nearly 40%. So that is yeah, as I said, it's hoping to give a really big boost to that sector, which has been struggling, I think, with kind of rising costs. So well, a raft of issues. So it really hopes that this will really give a really big boost. And yeah, it's great news, I think, for all involved. So I mean, as you can see, if you're thinking about, I mean, yeah, you've got basically almost a 15% increase on the kind of current audiovisual expenditure credits if you can qualify in that sector.
Claire, have we got a view on whether there's going to be other types of expenditure that might be included at a higher rate kind of going forward in future?
Yeah, I mean, in terms of the visual effects, I mean, there was quite a specific that was kind of quite a specific area that has been noticed as where spend has been moving away from the UK. But that's, I mean, it is showing an awareness of the government that they are kind of keen to make sure they keep the creative work here, and they are looking to ways to kind of make these reliefs as attractive as possible. So, I mean, I don't think immediately necessarily, but I think it's something that clearly that may happen in the future if there's specific other areas that that look like they may need some further help. So I think that covers the films, what's happened on the film side, and then to move on to the cultural reliefs. So theatres, orchestras, museum and galleries. There was, so in 2021, kind of post-COVID, there was enhanced rates announced for these sectors, and they were expected to decrease back to the kind of original rates that applied. The announcement in this budget is actually that the rates are going to be permanently kept at a higher rate. So I mean, I won't read through them, but you can see here that there's going to be a slight decrease, but nowhere near back to the 20-25% that we had previously. So again, that is a really welcome change, I think. And it has been a result of kind of much lobbying to keep them at that rate. And then, yeah, so I mean, that covers off the creative sector changes. And as I said, they were kind of the most exciting. Otherwise, it was a very, very quiet budget on the corporation tax side. I mean, as anticipated, there were no surprises. The rates of corporation tax have remained following the increase, and there's been no kind of sense that they will change. And then just very briefly to cover off the full expensing. So that has been introduced. So that applied from April 2023. And that basically gives full relief for capital expenditure. There was some talk around whether that would be extended to leased assets, because at the moment it only applies to assets which you own. And kind of the feel is that would be extended to the extent it can be afforded. So absolutely no commitment on there. And it's under consultation. So not saying no, but yeah, definitely nothing too exciting on that at the moment. And then there was a change to the VAT registration threshold, with the hope that this is going to help smaller businesses, removing that burden from them. So, I mean, the pre-existing rates have been in place since 2017. So, I mean, probably time that it was looked at. So, yeah, there's been a slight increase to the registration threshold, meaning that businesses won't be required to register until the turnover is 90,000, and then the deregistration turnover has also increased in line with that. And that is going to apply from April 2024. And then just to very quickly cover off some other business measures, not particularly in terms of tax rate increase or anything like that. So, I mean, they have announced that the Freeport's tax relief is going to be extended. So that is kind of certain areas that have been that the government have decided that will benefit from a raft of reliefs to kind of boost in that sector, all outside London. Then there is more interest around crypto assets, which I think are definitely becoming, well, increasingly used. And there's definitely internationally, there is a lot of kind of thought about how to make those transparent, how to basically stop them being abused. So the OECD did have published recently a report on that, and what the government are now doing is trying to work out how that will be implemented into domestic law. So there may be some changes on that going forward, but nothing too much to announce at this point. And then finally, R&D tax reliefs. Again, no changes on that front, but there has been quite a lot of concern about HMRC's implementation of the R&D schemes, particularly in terms of either clawing back relief or the inquiries that are being raised. So the government have said that they will set up an advisory panel, and the purpose being that this should kind of help and assist HMRC particularly on kind of technical areas to help hopefully improve how those are being administered and making sure that everyone is being treated fairly and there aren't kind of valid claims that are basically not being processed correctly. And I think that on the corporate side, as Francesca said, if you do have any questions, then pop them in the chat box and we can get to the end, or we can come back to you.
Perfect. Thanks, Claire. As we said, I think the corporate tax measures are always the most expensive for the government, aren't they? So it wasn't really a surprise that actually they were quite limited in this budget. Next, Leigh is going to take us through the personal tax points and those affecting owner managers. So over to Leigh.
Thank you both. Good morning, everyone. There were quite a few smaller changes on the personal tax and OMB front of interest, but you'll be pleased to know we're just going to run through some of the highlights. And if we don't cover anything that you're particularly interested in, then please do get in touch with us. One of the main topics of conversation of recently is in relation to how you extract profits from your company. And obviously, as you can see, if we can pause on this table for a second, advice has really turned on its head the last couple of years with some of the reductions in rates and increase in corporation tax. As you can see from the slide, which we will send out so you can peruse at your leisure, barring an LLP, which is the bottom line and has the lowest rates, obviously partnerships are good for some people, but not often for others, especially with the tax credits available within companies. So that aside, advice up to a few years ago was always everyone knew that dividends were cheaper than salary, and that, as you can see, we've run some figures, and that is now not the case. Unless you're a 20% taxpayer, if you're a 40 or 45% taxpayer, and as you can see, salary is actually now cheaper overall than paying a dividend. So that's just something to bear in mind. You know, when you look at your planning forwards and your profit extraction, please pause to take a note of what you're doing, how you want to do it, and also the timing of what you want to do, because that's important as well. You know, have a health check. Do you want to do the same as last year, or given all the slight changes, is a salary better than a dividend now? Certainly something to consider at the higher tax rates. Also bear in mind that salary is paid in real time, so that the tax on that will be paid as and when you pay the salary, whereas you might have a hybrid combination with paying a dividend at a time that's suitable for you and the company when cash flow allows. So it's certainly a very flexible structure, but advice has certainly changed. And whilst on this slide, I would mention, as I've starred down the bottom, pension contributions. Obviously, there's been change in the threshold and allowances there. So it may be, especially if you're getting nearer to withdrawing a pension of some kind and you've not used up your previous contributions and thresholds, then that can also be brought into the mix, because it's tax-free for you as an individual, and also tax relievable for the company, which brings the corporation tax rates down also. So overall, something to certainly look at moving forwards. And if you need any help on any particular issues that you've got, then please do get in touch with your advisor at Kingston Smith. So drilling down into those aspects, if we move on to national insurance, there have been some reductions in that. Firstly, for employees, currently there's a rate of basic rate 10% between the tax-free threshold of 12,570, and that's up to where the 40% threshold kicks in at just over 50,000. From April, it's going to go down to 8%, so there will be a saving there of, we've calculated at £754 per year. So over the last couple of years where there's been previous reductions, that's quite a significant difference of £1,500. And that obviously has helped the previous change in advice and methods of profit extraction that we went through on the previous slides. Unfortunately, there's no change to employers' national insurance, but overall, it does make a significant difference to how you extract your profits from your accounts, and when you do at a time that suits. There's also been some national insurance deductions and reductions for the self-employed. Class 4, which is the equivalent of Class 1 payable by employees, reduced from 9% down to 6% between the same thresholds. We'd all be pleased to know, and it's often forgotten, that Class 2 is being abolished. It's probably more of an administrative burden for ourselves and the government to administer as it is. So that is going from April. Not quite as large, but there are some savings for the self-employed, and that's an average of £650 per year on a rate salary self-employment income of 28%, 28 grand of profit. So that's Leigh, all good. So,
sorry, just a question on the NIC for the self-employed. Yeah. Given the reduction in the rates, is there any value in people reassessing their payments on account?
Yeah, good question. I think overall, absolutely, it's something that you should consider. The rates have gone down, so there are some savings, especially if cash flow is tight as it often is at the moment. It's certainly worth planning forwards and seeing what your actual rates will be in the forthcoming year or the year we're in now. But most definitely, it's certainly worth having a health check on your payments on account. You don't want to reduce them too low, because obviously if you reduce them down below what they are, HMRC will charge you interest on that. But I think now's the time, with these changes coming into place, it's certainly the time to give profit extraction and pension contributions and all those great things a little overhaul, just to make sure you're in the right place. But yeah, absolutely, now's the time. If you're not sure, it may be worth making the July payment on account, and then obviously you'll be in a better position to reassess the previous and current tax year at that point, and maybe reduce down at that point for the one payable at the end of the year. But certainly, and we can certainly help with that if anyone needs us. Moving on to other updates in relation to capital gains tax. This may be quite a useful one for some people. The two standouts, obviously, I'll mention carried interest briefly. That's in relation to private equity funds, and there are rumours by the Conservatives have got those rates, and also there's rumours from the Labour government as well that they are going to potentially move carried interest payments over to the income tax regime, so it's just treated like a normal income distribution. But that aside, there was a change in the capital gains tax payable on higher and additional rates for residential property. Now, this was in conjunction with trying to get the housing market move in that instance, because of the higher rates that were brought in previous years and the high rental incomes at the moment. People were hanging on to their properties, and obviously that stagnates the market. So from the 6th of April this year, it only applies to the higher or additional rates. So i.e. if you're a 40 or 45% taxpayer, that the rates are going down from 28 down to 24. So the timing of that, if you are looking to sell a property, may be worth considering. April isn't that far away, so you could have a 4% saving on that. Or obviously, having said that, if you're a lower rate taxpayer this year and you're a higher rate taxpayer this year, then 18 is still better than 24. So again, looking at your world at a holistic level with your profit extraction, salary and dividends, now's a great time to have a health check on that, just generally, and where you are with your cash flow and life planning in relation to your investments, etc. But it's certainly something that could be help people moving forward with regard to that. So again, the key message is to look at everything from a higher level. And moving on to a subject, non-domiciled and residents. It's something that has certainly been on the lips of governments as they stand at the moment. And if that slide's come up, Francesca. If not, I have my trusty backup in paper form. There it is, thank you. This may not affect many, and it is quite a niche area, and it is something that we're going to do a whole separate webinar on. So you can either switch off for a few seconds if you're not a non-domiciled individual, or please listen in. Just a brief introduction. You're non-UK domiciled as a general rule if your father was not born in the UK. It's quite an antiquated system that they are looking to revamp and update now. But to give you the highlights to see if this affects you or anyone that you know at all, if it's a new residence-based system that the UK are going to introduce. So it doesn't matter if you were born or your parents were born in a different country and you have come here to live and work. It will be based purely on whether you are a resident in the UK or not, regardless of whether you were born in the UK or overseas. And it's going to come in from April of next year. So it gives everyone who's affected by it a year to plan forwards. How they're going to make it work is that if you come into the UK, say from anywhere overseas, America, Europe, Asia, you're going to get 100% tax relief on any foreign income and gains that you earn outside of the UK within the first 4 years. That is the case generally at this point in time also. Obviously, anything you're taxed on that you've earned in the UK, whether that be from your UK business or from a salary, partnership, is still taxed in the normal way and subject to UK taxation. And then the new rules will be, once you're resident here for 4 years, your worldwide income will be taxed. So it doesn't really matter if you earn rental income in the UK, overseas, it will all be taxed. For those already that are resident in the UK from overseas and have been here fewer than 4 tax years, then you will have that increment up to your 4th year. And above and beyond that point, you will then be taxed on your worldwide income generally. So we are moving to a regime that mirrors, say, the US, where you're taxed on your worldwide income effectively if you're a resident in the UK. Obviously, there are people that have been here for more than 4 years who are deemed to be not UK domicile at this point, but have been UK resident for some time. And there will be some transitional rules and details published in due course in relation to how you swap from one system to another. But a niche area, but if that is of interest to you, then please do get in touch, because we can link you in with some webinars and advice that's specifically on this point. So moving on to another few points that we had, please, Francesca. So we've got child benefit. Now, this has been, I was watching Martin Lewis the other night, and obviously the campaigning for this, and I'm pleased to say is moving in that direction. At the moment, it's a very unfair system, whereas if anyone in the household earns over £50,000 per annum, then you either have to not receive child benefit or have to pay it back. That is now changing, because at the moment, if you have two people that are on £40,000 per annum, they get it. But if you have one person on more than 50 and say the other household member doesn't work, then you would not. So they are looking, it's not the full way, but they are looking to transition this into a more fairer system as we from April. So initially, the higher level limit for any individual person in the house has gone up from 50 to 60, which is a start, and child benefit will then be not fully withdrawn until income exceeds 80. And then moving forwards to make to realign everyone on the same path, from 2026, they are looking to apply the limits on a household basis and rather not an individual, to address this imbalance. So it may take a small amount of time, but on the whole, campaigning has gone well there, and they are looking to redress that balance. Another point, if it's of interest to anyone, is furnished holiday lettings. At the moment, you effectively run any furnished holiday let as a trade, and so there are some generous tax relief and benefits that are associated with that. Now, this is potentially to free up some of the properties on the coastal areas, such as Cornwall, in relation to that. So maybe that with the residential property reduction in capital, reduction in CGT, capital gains tax, it may work. We shall see. But the rules for furnished holiday let being treated as a trade are being abolished from April of next year. Moving forwards past that point, holiday lets will be taxed as a normal residential investment property. So the rules in relation to that will change. Obviously, if you own it personally, there are restrictions on mortgage interest if you have one. Is it worth moving into a company? There are various permutations and combinations that may suit some and not others. So it's certainly, again, this is a point in time with the changes, tweaks in the legislation and potential changes in government, that I would say if you have a furnished holiday let, then now's the time to have a health check on that, in line with all the other points that we've mentioned that may be have impact on you. There will, of course, be anti-forestalling measures on that, as ever, so that people don't try to push things forward and gain reliefs under the current regime that would normally be under the old regime. So that's just a standard anti-avoidance point there that the government have mentioned. And to summarise, obviously, we are at a point where an election will be coming up imminently, and there potentially will be a change in government. So we just had a think about where we are and in relation to now versus where we may be in relation to a change in government. And ultimately, the main headline one, I think, was the non-dom residence regime, where Conservative government have kind of stole the thunder of the Labour government changes that may be taking in place there. But at least, you know, as taxpayers, we have the relative comfort that where we are now is where we probably will be thereabouts in a year or so's time without any significant changes. And the same really applies to most things. There's no high level noise that there's going to be any major changes in the income tax rates, capital gains tax, or indeed a wealth tax at this particular point, above and beyond the additional rates that people pay now. And as Claire mentioned, the CT rate, the 25%, is roughly in line with most countries in the world now. So we are competitive there, and there's no advantageous rate there in relation to that, barring the tax advantage jurisdictions, which are, of course, under the spotlight at the moment. The big thing that we will mention, and we were just speaking about this in relation to client queries before the call, there is an indication that if the Labour government got in, they would be putting VAT on currently exempt private school fees. So that's just something to bear in mind, because that will be a significant additional cost if indeed that comes through. And we did come to the conclusion that if there are private school fees involved in your household, then schools are very much look into how they would deal with this. Are you going to prepay school fees in those kind of situations? So that is just probably the major red flag of change if it affects you. Lastly but not least, as mentioned previously, for private equity fund holders at the moment, if this affects anyone or anyone that you know, there is a distinction between what they earn as income and pay up to 45% tax on, and what they earn as effectively, I suppose, this capital gain, which as per the earlier slides is 28. And there is talk generally that any form of distribution in relation to private equity funds will be subject to income tax. So that's, again, quite niche, but may affect some people. And that, for me, I think is hopefully a high-level roundup of personal tax and owner-managed business.
Perfect. Thank you, Leigh. Unless anyone's got any questions that they want to kind of put in now, I think we've covered those off as we've gone through. So I think it just is just to reiterate, if there's anything that you want further information on or clarification on, then please do get in touch. We'll be sending out our usual feedback form after this session. If we could ask you please to spend a couple of minutes and fill it in, it just means that we can make sure that we are giving you the content that you want going forward. It really helps us. So thank you again for joining us today, and yeah, enjoy the rest of your day.
Thanks, everyone.
Thank you.